The story most people are told about taxes is simple. Work hard, earn more, pay more. It sounds fair. It sounds patriotic. It sounds inevitable. But that story quietly falls apart the moment you zoom out and look at how wealth actually behaves at the highest levels. Because for the ultra-wealthy, taxes are not a bill. They're a design problem. And design problems have solutions. This opens with a skyline, symbols of global finance floating through the air like currency ghosts. Not because cities create wealth, but because structure does. The wealthy don't ask, "How much tax will I owe?" They ask, "Where should this income exist so it isn't taxed the way everyone assumes it must be?" The title isn't about secrecy in the criminal sense. It's about complexity, obscurity, and intentional distance from how normal people earn and report income. Billionaires don't earn money like employees. They don't rely on wages. They don't depend on salaries. They own systems, and systems obey different tax rules. Here's the uncomfortable truth. The tax code is not broken. It is functioning exactly as designed. It rewards ownership, leverage, long-term assets, and jurisdictional arbitrage. The wealthy didn't hack the system. They learned it deeply enough to play it correctly. Most people are stuck inside a single tax lane, income in, tax out. The wealthy operate across multiple lanes simultaneously: entities, trusts, partnerships, jurisdictions, asset classes. Money flows sideways, not just up, and every turn changes how it's taxed. This is why two people can make vastly different amounts of money and yet experience completely inverted tax realities. One works harder and pays more. The other structures smarter and pays less. Same country, same laws, entirely different outcomes. This sets the tone. This isn't about envy. It's about understanding. If you don't understand how wealth is protected, you'll always wonder why the numbers never seem fair. And if you do understand it, something powerful happens. You stop asking why the game feels rigged, and you start seeing where the levers actually are. The real divide isn't rich versus poor. It's structured versus unstructured. And once you see that, you can't unsee it. The shock isn't that wealthy people pay less tax. The shock is how openly it happens, and how legal it is. This scene juxtaposes two worlds: luxury on one side, kitchen tables covered in bills on the other. Same economy, same tax code, completely different experiences. When people hear that a billionaire pays a lower effective tax rate than their own assistant, it sounds like a scandal. But it's not an accident. It's math plus structure. Billionaires don't earn income the way employees do. They borrow against assets. They defer gains. They convert income into appreciation. And appreciation isn't taxed until it's realized, if it ever is. This explains effective tax rates versus headline rates. Most people look at the top marginal rate and assume the wealthy are crushed by it. In reality, very little of their economic power flows through taxable income at all. It lives in equity, carried interest, unrealized gains, and asset-backed leverage. Here's the key insight. Taxes punish velocity, not mass. The faster money moves into your hands as income, the more it gets taxed. The wealthy slow money down. They let it sit inside entities. They let it grow silently. And when they do access it, it's often through loans, non-taxable by nature. This pulls back the curtain on the emotional manipulation baked into the system. Workers are told they are doing well because their paycheck grew. But the more your paycheck grows, the more visible and taxable you become. Wealth prefers invisibility. And yet, this isn't about villains twirling mustaches. It's about incentives. The tax code incentivizes long-term ownership, risk-taking, and capital formation. The wealthy simply follow the incentives relentlessly. The real shock is this. The system is available to more people than they realize, but almost no one is taught how to use it, because teaching it would shatter the illusion that taxes are just a fixed cost of success. Delaware isn't famous for beaches or mountains, it's famous for paperwork. This scene zooms into a plain office building, unremarkable, quiet, almost boring, and that's exactly the point. Power doesn't announce itself. Over 1 million companies are legally located in Delaware, many of which have never set foot in the state. Why? Because Delaware perfected the art of corporate friendliness. Flexible laws, predictable courts, minimal disclosure, and most importantly, control. This explains how incorporation location can matter more than where business actually happens. By choosing the right jurisdiction, companies gain legal shields, tax efficiencies, and strategic leverage. It's not about hiding, it's about positioning. The Delaware structure allows income to move between entities, royalties to be paid internally, and profits to appear where they are taxed least. Intellectual property is often parked here. Licensing fees flow through here. The result? Profits shrink where taxes are high and expand where they're low. For small business owners, this feels inaccessible. But for large enterprises, it's standard operating procedure. This scene reframes the narrative. The wealthy don't cheat. They incorporate intelligently. The real lesson is subtle. Geography still matters in a digital world. Legal geography, paper geography, entity geography. And those who understand it can dramatically change their tax exposure without changing what they actually do. This ends with a quiet realization. Sometimes the most powerful tools look boring, and the most expensive mistake is assuming your home address should also be your financial address. Palm trees, blue water, glass offices by the sea. This scene contrasts paradise with spreadsheets, because the Cayman Islands are not about vacation, they're about capital gravity. The Cayman Islands host trillions in assets despite having a tiny population, not because money likes beaches, but because money hates friction. No corporate income tax, no capital gains tax, no withholding tax, just flow. This explains how multinational corporations and hedge funds route investments through offshore entities. The money isn't hidden under mattresses, it's parked inside legal frameworks designed to minimize drag. The IRS knows this exists. Governments know this exists. And yet it persists because global capital is mobile. If one country tightens too hard, money simply moves elsewhere. The Cayman Islands didn't create this. They capitalized on it. This reframes offshore structures as mirrors, not monsters. They reflect how nations compete for capital, and capital always chooses the path of least resistance. The uncomfortable takeaway: taxes are not just a civic issue. They're a competitive one. And countries that forget that lose capital fast. Behind closed doors, entire families operate like corporations. This scene enters the boardroom of a family office, quiet, methodical, generational. A family office isn't about luxury, it's about coordination. Lawyers, accountants, investment managers, and tax strategists, all aligned under one mission: preserve and compound wealth across generations. This explains how trusts, annuities, and estate vehicles allow massive wealth transfers with minimal taxation. The rules are complex by design. Complexity favors those who can afford teams to navigate it. The key insight: the wealthy don't plan year to year. They plan decade to decade. Taxes become irrelevant when timelines stretch long enough. This challenges the viewer. If you only think in annual terms, you'll always lose to someone thinking in lifetimes. Art hangs silently, but it speaks volumes. This scene explores how art becomes a financial instrument disguised as culture. Paintings appreciate quietly. Appraisals are subjective. Donations create deductions. Museums create control. This isn't about aesthetics, it's about valuation flexibility. The wealthy don't just buy art for beauty. They buy it for optionality. And optionality is where tax efficiency lives. This emphasizes that the tax code often values intent less than structure. If an asset qualifies, it qualifies, regardless of how clever the strategy feels. Sunlight, modern villas, and a simple rule: move your body, move your tax rate. This scene breaks down how residency, not citizenship, often determines tax treatment. Puerto Rico becomes a case study in incentives. Live here long enough, invest correctly, and your tax reality changes dramatically. This underscores a brutal truth. Loyalty is expensive. Mobility is rewarded. Champagne glasses clink on a trading floor. This scene explains carried interest, how income becomes capital gains through labeling, not labor. Private equity managers aren't taxed like workers because their earnings are defined differently. Definitions matter more than effort. This reinforces the theme. Whoever defines the income controls the tax. Empty classrooms. Cracked walls. This scene brings the cost into focus. Tax optimization doesn't happen in a vacuum. It creates gaps. This isn't a moral judgment. It's a systemic consequence. When capital escapes, someone else pays. This asks a hard question. Can a system survive when participation is optional for the most powerful players?